Hey there, scholars. Just one more brief concept to cover in chapter 10. We'll finish it out. No mini exercise in this video, but today, this topic of this video is capital rationing. So this happens when a firm has positive NPV projects, but doesn't pursue all of them. And there's two kinds of capital rationing I want you to understand, and let's get into it. So soft rationing is some internal limit, and it could look something like this. This happened at my work, actually, when I worked at Deutsche Bank. So suppose we had different divisions, right? Division A, B, and C. And then the way the budgeting process worked, like each division asked for a certain budget of new projects to do in the coming year, right? And presumably based on positive NPV projects that were out there. But it wasn't always the case that the money we got was representative of the positive NPV projects we had, right? So some years, like just hypothetically, each division might get a budget of $200 million, right? So you can start projects that cost $200 million across each of the three divisions. And so if we had projects, positive NPV projects that we wanted to do, and suppose those projects cost $350 million, right, there just wasn't going to be enough money to fund all of our positive NPV projects because it's like some internal limit set on spending on new projects. So that's soft capital rationing, right? And so that's not ideal for shareholders if some positive NPV projects don't get funded because of this, right? But soft rationing comes from within. Hard rationing, on the other hand, is imposed by financial markets. So it could be the case that a firm, this is much more common among newer firms that are trying to scale up rapidly, or young firms that want to grow a lot. Those are synonymous. But if a firm wants to get external financing to pay for a project, right? Firm has a new product idea that's going to, revolutionize whatever market it's operating in, and it just needs like a $200,000 loan to get the assets it needs to get the project off the ground. But if no bank is willing to lend them $200,000, or if they can't sell $200,000 worth of bonds, if they can't get the money they need from financial markets, that's hard rationing. And you can imagine that being frustrating for an entrepreneur who's got a business that they're trying to scale up, or has a great positive NPV project that just doesn't get funded. Hard rationing. So that closes out chapter 10. Thanks for tuning in as always. And in the next chapter, we'll go into more detail on what goes into determining the cash flows on these cash flow timelines, because we take them as given in these examples, but in real life, forecasting of projects' cash flows is actually pretty challenging. So we've got a chapter devoted to that. Thanks for tuning in. See you next time.